Welcome to Breaking News to Trading Moves. Imagine having an $8.5 billion checkbook.
That is a lot of capital to throw around.
Right, and you can put that capital absolutely anywhere in the world. You could buy software companies or, I don't know, artificial intelligence infrastructure.
Or sprawling logistics networks.
Yeah, exactly. But instead, you decide the absolute best place to park that capital is in dirt, lumber, and drywall. And right in the middle of a prolonged housing affordability crisis, too.
It definitely catches your attention.
It really does. When a major acquisition hits the financial wire, it is very easy to just glance at the top line number, shrug, and move on with your day.
Oh, people do that all the time.
Yeah, but our mission for this episode is looking directly at exactly this kind of major acquisition headline and then breaking down the specific winners and losers across the market. We want to show you exactly where capital is flowing and what it means for you as an investor trying to navigate the housing sector.
Right, because the headline we are analyzing is a major one. Berkshire Hathaway is agreeing to buy Taylor Morrison Home Corp outright.
So let's lay out the exact numbers so you have the full picture right from the start. Berkshire is stepping in with a $6.8 billion cash transaction.
Which is massive.
Yeah, and when you factor in the existing debt they are taking on, it values the deal at about $8.5 billion. They are paying $72.50 per share.
Right, representing a 24% premium to Taylor Morrison's previous closing price.
Yeah.
And, the timing is really what makes this transaction stand out.
How so?
Well, Berkshire is placing all this capital into the United States housing market right at a time when interest rates and overall housing affordability remain ongoing concerns for buyers.
Yeah, which brings up a question I have regarding the mechanics of a buyout of this scale. We are looking at a cash transaction that is just incredibly large. How does an all-cash buyout operate differently than a standard financed acquisition?
It is a completely different operating environment.
I mean, a $6.8 billion check just feels entirely different than a leveraged buyout from a private equity firm, right?
Oh, absolutely. When a standard corporate buyer or a private equity firm uses debt to finance an acquisition, they are completely at the mercy of the credit markets.
Right. They have to take out syndicated loans.
Yeah, and if lending rates are elevated, their cost of borrowing eats directly into the profitability of the deal.
Right.
They also have to worry about debt covenants.
Those are the strict rules set by the banks, right?
Exactly. Rules that require the company to maintain specific earnings levels. They have to monitor interest coverage ratios, essentially proving every quarter they make enough money to pay the interest on their debt.
So it's a lot of pressure.
Yes, but an all-cash buyout removes all of that machinery. Berkshire doesn't have to beg banks for a loan. That gives them a level of certainty and speed that finance buyers simply cannot match.
Wow.
It also means they evaluate the return on this investment without the drag of interest expenses clouding the math. They look strictly at unlevered free cash flow.
Okay, so they are buying the underlying business, not a financial engineering project.
Exactly.
Let's move logically from the headline numbers directly into the two companies involved in the transaction because they are the immediate winners here.
Yeah, they were the most direct beneficiaries.
Let's look at Taylor Morrison first, ticker TMHC.
Well, Taylor Morrison is undeniably the clearest winner. For their current shareholders, the narrative is very straightforward. The buyout price delivers a strong, guaranteed cash premium to its current shareholders.
Right, they get that 24% premium over the previous club.
Locked in, without having to wait out the current uncertainties in the broader real estate market.
And then we have the buyer, Berkshire Hathaway, tickers BRK.A and BRK.B. How exactly do they benefit from paying an $8.5 billion enterprise value right now?
Berkshire benefits because of their unique corporate structure and timeline. They have the patience and the cash reserves to invest through a multi-year housing cycle.
So they aren't worried about next month's numbers.
No, not at all. By acquiring Taylor Morrison, Berkshire gains the ability to build a larger housing platform, a platform that spans home building, manufactured homes, building products, and real estate services.
I like to think of Berkshire's strategy here like a patient gardener.
A gardener.
Yeah, imagine a gardener who decides to buy an entire orchard right in the middle of a drought. Other farmers might be panicking about the lack of rain and desperately trying to take out loans to pay for water.
Right.
But this specific gardener has a private reservoir. They have enough water, meaning cash, to wait for the multi-year harvest. They know they can ride it out.
That is a great analogy. They aren't looking at next quarter's earnings calls. They are looking at the demographic demand for housing over the next decade.
So let's talk about the competitor companies. Depending on how investors look at the broader industry versus direct competition, the exact same companies can be viewed as both winners and losers.
Yeah, this is where the market reaction gets a bit complicated.
Let's start with the winners angle.
The winner's angle revolves entirely around sentiment and valuation multiples.
Yeah.
Large builders are not being acquired today, but they operate in the exact same broad industry.
Right.
Investors look at this deal and realize that a highly respected buyer just placed a clear valuation marker on the home building sector.
So the market evaluates these large peers differently now.
Exactly. They revalue these companies for their scale, land control, and balance sheet strength.
So if you hold Lennar, ticker LEN, or NVR, ticker NVR, your portfolio just got a validation check. We are also talking about D.R. Horton, ticker DHI, and PulteGroup, ticker PHM.
Precisely. If Berkshire is willing to pay a 24% premium for a home builder, institutional investors immediately start running the math on Lennar and D.R. Horton. Wall Street analysts will start upgrading price targets because the baseline assumption of what a builder is worth just got recalibrated.
But on the flip side, we have the loser's angle. These exact same rivals now face tougher competition.
They absolutely do. Before this deal, Taylor Morrison was a standard public competitor operating under the same constraints as everyone else.
But moving forward?
Moving forward, they are backed by Berkshire's duper capital. They have a longer time horizon and greater flexibility regarding land, incentives, and growth.
Wait, explain the land part. How does having Berkshire's checkbook change how they buy dirt?
Buying raw land involves heavy holding costs. A normal developer takes out loans to buy raw dirt, and then they have to wait for local municipalities to approve zoning and permits.
Which can take forever.
Exactly. And holding that dirt while paying 7 or 8% interest on a commercial loan eats into their margins every single month. Berkshire buys dirt with cash. They can literally wait 5 or 10 years for a municipality to approve zoning, costing them nothing in interest.
Which means they can outbid competitors for the best prime lots because they don't have to factor in those crushing carrying costs?
Yes. And beyond land, they can offer far more aggressive incentives to homebuyers. In a tough affordability market, builders rely on mortgage rate buydowns.
Oh, right, where they pay points to the lender to lower the buyer's mortgage rate.
Exactly. That crushes the builder's gross margins. Berkshire can absorb that margin hit effortlessly to gain market share.
Which creates tougher competition for buyers, for raw land, for labor, and for profit margins. And the tickers in this crosshairs include D.R. Horton, ticker DHI, PulteGroup, ticker PHM, Toll Brothers, ticker TOL, and KB Home, ticker KBH.
Right.
But I have to push back here. D.R. Horton and PulteGroup just appeared on both your winners list and your losers list.
They did.
So how is an investor supposed to evaluate a stock that receives a valuation boost but simultaneously gains a much stronger direct competitor? It seems like a contradiction.
It does seem that way, but it raises a vital question about timelines. In the short term, the valuation marker is the dominant force. The stock gets a bump because the whole sector is perceived as more valuable.
Okay, so short-term traders might play that bump.
Right. But over the long term, the operational reality dictates earnings. An investor has to weigh the immediate positive sentiment against the reality that D.R. Horton and PulteGroup will be bidding against Berkshire's checkbook for land 2 years from now.
So long-term holders need to evaluate that margin compression. Let's move logically from the builders themselves to the physical materials required to construct those homes.
Every single new home built or acquired drives demand for physical products.
Right, so we look at the housing supply chain and home improvement sector as immediate winners.
Yes, builders rely on a massive ecosystem of specific materials. To construct a house, you need lumber, insulation, roofing, fixtures, paint, and repair products.
I like to use a pick and shovel analogy here.
Oh, how so?
Well, you can liken the home builders to the gold miners. While companies like Builders First Source, ticker BLDR, and Owens Corning, ticker OC, are the ones reliably selling the tools and materials needed for the job.
That is the exact dynamic, and it extends beyond just the initial construction phase.
You mean follow-on demand?
Yes. Housing turnover and new construction support renovation spending. A new home creates follow-on demand across both materials and retail.
Which brings retail directly into the conversation. Tickers like Home Depot, ticker HD, and Lowe's, ticker LOW.
Exactly. They cater heavily to professional contractors. When new construction scales up, subcontractors are booked solid, and they source their daily materials from these big box retailers.
So let's turn the conversation from the business of buying and building homes to the business of renting them. This focuses on how investment capital rotates.
Right, rental housing names could be affected if investors decide to rotate their money out of rental REITs and into home builders and supply chain stocks.
Let me call out the tickers here first. We are looking at Invitation Homes, ticker INVH, American Homes for Rent, ticker AMH, Equity Residential, ticker EQR, and Avalon Bay Communities, ticker AVB.
Institutional investors generally have a fixed allocation for real estate. If they want to buy into the home builders, they have to sell something else within that real estate allocation to fund the purchase.
But wait, I want to question this rotation.
Okay, what are you thinking?
Earlier, we specifically noted that rates and affordability remain ongoing concerns for buyers. If it is hard for the average person to buy a house, shouldn't rental properties still be in high demand?
That is a very valid point, and you are entirely correct about the underlying consumer demand. Rental stocks generally benefit when housing affordability is weak
So why would investors rotate out of them?
because the stock market is forward-looking. Builders benefit if investors start looking past current conditions toward a better housing cycle.
Oh, so the capital rotation happens before the reality on the ground actually changes?
Exactly. Investors see Berkshire placing this massive bet on the future of buying homes, and they start moving their money to align with that future.
That makes a lot of sense. So that leads us to our final group of losers, the smaller or more rate-sensitive housing names.
The challenge here is entirely about economies of scale. Smaller housing companies will face increased investor scrutiny following this transaction.
Because they have to prove they can compete in a market where scale is becoming more important.
Right. If capital, land access, and the ability to offer buyer incentives matter more going forward, these smaller names will be at a disadvantage compared to giants.
We are talking about tickers like Meritage Homes, ticker MTH, MI Homes, ticker MHO, Champion Homes, ticker SKY, and Beazer Homes, ticker BZH.
When a smaller regional builder goes to a bank to finance a new subdivision, they pay elevated commercial interest rates. But when Taylor Morrison, backed by Berkshire, builds across the street, they use incredibly low cost of capital, or just pure cash.
The small builder simply gets squeezed. So what survival strategies actually exist for these smaller, rate-sensitive builders when a giant with endless cash enters their neighborhood?
They have to rely on hyper-local expertise.
Right.
A massive national builder cannot be perfectly efficient in every single micro-market. Smaller builders have to leverage their local relationships.
Navigating local zoning boards and city councils.
Yes, more nimbly than a massive corporation can. They might also need to focus on highly customized luxury builds rather than massive tract housing.
So they have to play a completely different game.
They really do.
Well, I want to leave you with a final thought to mull over. Consider how capital rotation works in your own portfolio. When one sector gets a sudden injection of cash and attention, evaluate where that money is flowing out from.
Yeah, that is crucial.
And look at what secondary markets are supplying the raw materials. That is often where the best opportunities are hiding.
Very true.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thank you so much for joining us for this conversation. Keep watching the market, and we will catch you on the next one.